be doing, but thanks for everybody for joining. My name is Assad, but I'm the Director of Ventures and Partnerships at Kinship, and one of the people that leads our Leap Venture Studio, which is an accelerator program. We'll get through that in a second. I also want to quickly introduce Isabel, who's on our team. Isabel, you want to just quickly say hi? I'm sure you all know Isabel. She's the one behind all the stuff at the Leap Venture Academy. So really excited about this conversation today. We're going to talk about how to fundraise for your pet care startup, a discussion on VC, angel, and crowdfunding options. Really happy to have Gertrude from Peplete and Wesley from Leah Labs, two of our community members that have been really engaged in a lot of what's happening at the Academy. And I'll have them introduce themselves in just a bit. A little bit of housekeeping. We're going to do probably 30 minutes of a discussion. I'll ask some questions of them. And then we'll open it up to anybody who wants to ask questions. We're asking because we're expecting a lot of people right now. It looks like there's about 25 people on that you ask your questions in the chat window, and you'll be muted the entire time. And just for the record, we are recording this, and it will be posted up on YouTube afterwards. Also, as you're joining, if you could just quickly share your name, where you're from, and what company you're with in the chat window. That would be fantastic. And a little bit about Leap Venture Studio and Academy. I'm sure a lot of you who have been joined some of this stuff before know about this, but we are here to serve you, pet care startups across the world. We know that a lot of people are out there trying to change the industry and bring new technologies to the market and new business models and disrupt the industry. And we are here to support you. We are a joint partnership between two organizations. Michaelson Found Animals, an amazing social nonprofit down in Los Angeles that does some really cool things. Isabel works for them. And Kinship, which is a division of Mars Pet Care, and I work for them. So it's a really cool partnership. Leap itself, I want you to think of two big things that we do to help the pet care community. The first is our Leap Venture Academy, which is basically programming like this. We're trying to help startups get the resources and the connections that they need to get to the next level, whatever that next level may be. And we have pitch opportunities, we have boot camps, we have webinars, and we should be making a big announcement in the next couple of weeks about our programming for the rest of the year. So stay tuned to that. If you ever have any ideas on things that you want us to do, definitely let me or Isabel know, and she'll be posting ways to engage in the Slack channel throughout the conversation today. And then we have our Premier program, which is a Leap Venture Studio program. Peplete went through that, I guess, 2 years ago, maybe. And so basically every year we're bringing 7 of the best pet care startups from around the world. We bring them to LA in a pre-COVID world and virtually in a post-COVID world. We're investing up to $200,000 in them and really giving them the resources that they need to get to the next level. We've done that now with 19 companies, including Anne, who just posted on in the Slack from Jiminy's, and I think a couple others are on as well. And so we're gonna, as we talk about fundraising, I just wanted to spend 2 or 3 minutes going through sort of a primer. And then we'll open it up to Gertrude and Wesley's kind of comments. But, at a high level, before you can get funded, you have to know where to look. And before you know where to look, you have to really understand what you are as a company. And so, this is just 4 ways to break out like how you would categorize yourself as a company. There's many more, but, are you a social venture company? Are you a normal growth company? Are you a high growth company, or your extreme high growth company? And depending on what you answer for that or what you figure out really depends on the type of capital that you go after. And funding comes in all different flavors. There's no one model that fits all startups. You really have to kind of know who to go after based on who you are as a startup. The most basic rule here is the more risk a funding partner takes on, the more return or control they're going to require in the company. Just really quickly, as people join, if you could mute your audio, that would be fantastic. And then I'll send these slides, by the way, to everybody afterwards, or Isabel and I will send them. But, basically, as you go through the process, as you bring on more as you develop your company more, you reduce the risk to your financial partners, and that's kind of really great, and so there are all sorts of different types of capital out there. We're going to talk about a couple that the two startups joining today have gone after. But this is, I think a lot of people, when they think about funding, they think about angel and VC, but really there's a ton of different options out there, and you really got to find the best mix for your startup based on what you're doing. And so this is just, based on those kind of four categories. Sorry, I'm just admitting people as they come in. These are at a high level. Again, this is not the end all be all, but this is just one way to look at it. The type of capital you should go after based on who you are or what your company is doing. And then the alternative sources of capital, the best thing that you can do is bootstrap. And especially in a COVID world where fundraising is becoming increasingly difficult in the short term, and unclear what it's going to be in the long term, the more you can do to bootstrap and save money and keep money in the bank, the better. But there are all sorts of other options out there. You can ask your vendors, you can try to get grants, go after some government funding, business plan competitions, and then, our accelerator as well. We run a couple pitch competitions every year where we give out prize money to winners. And then one other thing that I wanted to share is, because a lot of people aren't sure, but when you go after VC funding, this is kind of the funnel that they go through. They are looking at hundreds of companies, if not thousands of companies, to go out to invest in a handful of companies, and so, just imagine, how hard it is to get that funding. And then it increases if you are specialized in any way, or how long it takes you to get to market. And I'm sure Wesley's going to talk a little bit about his his stuff as well. And then it becomes even harder if you are a first-time entrepreneur and you haven't done it before. And all funding is trying, all you have to do not all you have to do, but one of the big things that you have to do as you're talking to investors is really de-risk the money that they're going to put into your company. And how do you do that? By building a great team, building a great product, focusing on the fundamentals of the business. Okay, yes, Constantine, we are going to send this out afterwards. And with that, I'm going to bring on Gertrude and Wesley. Gertrude, wanna just jump on and maybe give a one-on-one on your background and what Peplete is?
Absolutely. So first, Peplete is a DTC brand, a direct-to-consumer service. We make fresh cooked food for dogs. We make the food using only human-grade ingredients and we make the food in a USDA facility alongside human food. So it's really the highest, arguably one of the highest food on the market, based on the ingredients and the way it's made. We do ship it in an insulated carton. So the product gets flash frozen after it's cooked, and it ships in a frozen state. But when the consumer receives it at their front door, they're going to put the food in the refrigerator or the freezer, just depending on how much food they receive in the box and how quickly they think they're going to use the food. If they're going to use it right away, they would put it in the fridge. So it is a product that's intended to be kept cold, but it can definitely be stored in the fridge. If it's going to be, if you're going to get more than a week's worth of food in your box, you're going to put the rest in the freezer just to preserve it. But we don't use any preservatives. The only thing that preserves the food is keeping it frozen. Otherwise, it has no preservatives in it. Nothing artificial, obviously. It's an all natural product. The benefit to the consumer is that the dogs, tend to love it. They go crazy for the taste, and the flavor is great for them. But more importantly, is just that it has tremendous health benefits. The dogs on our food tend to just live really a happy and healthy life. They have more energy. They are, their digestive system works really well. So their bowel movements are better. Consumers, and we have thousands of customers, they report to us less trips to the vet because they just run into less health issues. And for dogs who are suffering from certain health conditions, a lot of times it is related to the food that they're eating. And so by switching to a fresh cooked diet, they see a lot of those health issues resolved. So those things are, things like weight issues, either underweight or overweight, allergy, issues. So, itchiness, the coat maybe not being healthy, teeth not being healthy, ear ducts being clogged, those type of things can actually be resolved with a healthy diet. And it really is interesting to see just how quickly changes occur. In dogs, it can be sometimes just in a matter of a few days or a couple of weeks. And they, being a direct-to-consumer brand, we have such a very intimate relationship with the consumer. They write to us when things are going well and when they're not going well, and we obviously try to resolve the issue right away. But we do hear from our consumers, about really almost everything. It's a really, really great interactive kind of dialogue. So we've been in market for 3 years now. We launched officially in the spring of 17 as a national brand, shipping into every state as we do today. We've served well over 10 million meals by now. And, we joined the LEAP. We got into the first accelerator, the first cohort of the LEAP Studio Accelerator. And that was in the summer of 18. So we'd only been in market for, maybe a year and a half. And so it was really a pivotal time for us to be able to accelerate our business. At that point, we had a very strong foundation, but we were still relatively small. The support we got from LEAP, which was really, looking back, tremendous. I mean, we felt it as we were going through, but really looking back, we can safely say it was such a critical juncture for our business to get that kind of support. And so, the following year and a half has been actually very, very strong for us. We did spend, after the LEAP Accelerator, a lot of time was spent actually based on what we learned in the accelerator, really kind of shoring up our metrics. So we knew where we had some opportunities to improve with the help of Mars on the product development side, with RGA on the marketing side, with the whole ecosystem around LEAP, just getting inputs on various, metrics that we needed to improve. We spent a lot of time doing that, which actually allowed us to then raise a Series A round of funding at the beginning of the year. Timing was obviously great because it was completed before COVID set in the US. And so we were very, fortunate for that. But we raised a $9 million round of funding in January. And now we really are able to scale the business because we have the additional funding and, resources, and we're able to expand our team so we have more bandwidth to achieve all the different, objectives that we've set out for ourselves.
Right. We're going to dive deeper into that for sure, Gertrude. Thank you. Yeah, that's awesome. Wesley, you want to share your story a little bit?
Yeah, you bet. So Leah Labs is a research stage biotechnology company. So we are focused on bringing cell therapies to dogs. So cell therapies are, the use of living cells. And then we use gene editing to then reprogram those cells so that they can have a therapeutic effect in the patient. So cell therapies have been around for decades and generally have only been used in humans. The past few years, there have been some cell therapies that have transitioned into the animal health market. But we are really, the first company that we know of to be using gene editing, which is my expertise, to actually enable the transition of cell therapies to dogs in this way. And so we're first focused on curing cancer in dogs. So B-cell lymphoma, of course, kills about 250,000 dogs in the US every single year. And there's a clinical analog of B-cell lymphoma in humans. It's called non-Hodgkin's lymphoma. And there's a currently approved therapy called CAR T-cell therapy for this type of cancer in humans. And so we realized that with our gene editing expertise, veterinary expertise, and then on the human side, CAR T-cell expertise, that we could put all of this together and kind of bring, these therapies to dogs. So that's just the first product, but really, we are focused on becoming the next Zoetis. And instead of in pharmaceuticals, really in biologics and living therapies. So actually using living cells to provide therapeutic value.
Fantastic. Can you, Wesley, can you share a little bit about your funding journey, how much you've raised and how you raised it, and then we'll dive deeper in.
Yeah, you bet. So our company got launched right after I finished graduate school. So I finished my PhD on like a Friday and jumped into the company full time on Monday. Then the reason that I was able to kind of finish my PhD and jump into the company that way is because the first money into our bank account was being accepted into the accelerator Y Combinator. So that was super awesome for us, obviously, really jump-started the company, and really set expectations quite high for us. And so because YC was the first money into our bank account, we hadn't actually run a science experiment as Leah Labs. Coming out of Y Combinator, fundraising was a bit of a challenge. So if you guys know much about Y Combinator, you know, it's the leading tech accelerator in the world. Funded companies like Airbnb and Dropbox and Reddit. Generally, they're into tech versus biotech. And so they're getting better at funding biotech, I think, but I think we were an experiment for them because they're a startup too, at least they like to talk that way. And so we rolled out a YC, really not having hit milestones that are possible in 2.5 months of YC, to raise, you know, a venture capital round of $2 million at a $12 million valuation. So we kind of struggled through some fundraising in that way, and it kind of came to a point where we were really going to give up the dream in July or launch an equity crowdfunding campaign. So that's what we chose to do on WeFunder, and that actually had some great success for us. So on WeFunder, we were able to raise a Reg CF round of about 470,000 is about where it closed. That's money in the bank. And then through the Reg CF campaign, that, you know, that gave us life to continue writing grants. So now we've had 360,000 in grant funding, including an NSF SBIR. And then also through just being around longer and having raised more money on Reg CF, we were able to close some additional angel checks as well that wouldn't have came in the door unless we had some initial funding. Of course, an angel investor doesn't want to write you a $10,000 or $100,000 check if they don't think that you can close out a round, because that money would just be kind of useless if you can't hit, you know, those next milestones. So in total now, with our dilutive funding and non-dilutive funding, we're up to almost 1.3 million. So we're really excited, obviously. And now, you know, we have everything we need to kind of get that first milestone of taking our therapy, proving it in vitro, getting it through a safety study, and then actually getting it into some sick patients on our current runway, which should then unlock a Series A for us.
Great. Excellent story. A question for both of you. How did you decide the amount of money that you wanted to go after for your funding rounds? And it could be either your angel or you know, your crowdfunding. And how much of it was, you know, how much did that change as you were going out to pitch to investors as well?
Yeah, so I'll take that one first. I mean, coming out of Y Combinator, there was a lot of hope and, you know, fanfare that we would be able to raise $2 million. So I kind of built a budget for how we could spend $2 million. You know, I still would love to be able to spend $2 million, but that's not how it worked out. And so, of course, you know, every time you pitch, you're iterating on your pitch deck, and you're also iterating on how much money you think you need. And then also, you know, as you get further and further along in your process, you can kind of refine how much money you need as well. So for us, when we launched the Reg CF round, you know, the max you can raise on WeFunder is $1 million. And of course, that was the hope. But then kind of as we got going through it, you know, as I said, we raised 470,000 or so. And so really, we just kind of ended up to where we knew that we could get to that next milestone. So really, of course, you don't want to raise more money than you need to get to a next milestone where you're going to increase your valuation, of course. And so, you know, we just realized after time went on, and when we kind of got to where we knew that we couldn't raise any more money, that this is kind of what we had to work with, and it kind of just worked itself out in that way.
Okay.
Yeah, our story is probably similar in that we have, from really inception at Peplete, chose to raise as needed. So there's different philosophies, and I know even in our category, which is still a relatively new and emerging category within the pet food space, you know, different companies have taken different approaches. And I think it's largely driven, well, one, by the founder, their personality, maybe their background. You know, if they came from a finance, if they have a finance background, they maybe take a different approach than somebody who has an operational background. And then the investors that you partner with, and you probably, if you're a finance guy, you're probably partnering with very financially driven investors, versus if you're operational, you may find investors that have more of an operational background and passion, and, you know, the financial piece is there just to kind of achieve the operational goals. So we've gone the route of operational, largely driven by our, as I mentioned, our Ronaldo Webb, our founder, the founder of Peplete. He has an operational background. He was a McKinsey consultant. He was a consultant with L. Catterton Growth, one of the largest consumer private equity firms in the world, and he was in their their kind of their consulting division, and he consulted on operational matters with a variety of pet food companies. That's how he came up with the idea for pet food, for Peplete rather, and all of that to say, he looked at it very operationally, and so no surprise he partnered initially with the funds that he initially partnered with, including one that I came from, which is called Brand Project. We look at things very operationally as well. We all have operational backgrounds, and then we use the finance, as I said, just as a growth accelerator. So when you look at a business that way, you think about, what do I need to operate the business? Like, what are my goals and what do I need to get there? And I'll raise that much money versus, the other way around, which is like, kind of backing into a situation where you say, well, if I had 10 million, what would I do with it? And that's what some of our competitors have done. All of these ways can work fine. I just know for us, we have this bias towards, raising as we need to achieve certain goals at the stage we're in, not trying to achieve the goals that we should be achieving 5 years from now, trying to achieve the goals that we need to achieve this year and next year. The upside, there's an upside and downside. I'd say the upside of doing it the way we've done it is that we preserve a lot of value in the business, right? We're not this inflated, sort of business that has just an enormous amount of investment, like, hovering over us, and we don't have such a lot of investors. It's, there's a nice freedom that comes with just raising the money you need and spending it, as you need to. The downside, I would say, is that, and where our competitors have an advantage, if you have a lot of cushion, you can try a lot of other things. You can test into a lot of different things, products, marketing, et cetera. You have a lot more room to make mistakes. You maybe can move faster because I can mess this up 3 times and I'll still have more money to launch the 4th time. We can't operate that way. We have to be super really, disciplined and very diligent, and our decision making is very thorough and methodical. And so when we launch, we know we have a really high success rate or probability that this is going to be successful. And we've had a very high success rate when we have launched new products and new marketing campaigns because of the way we've approached it. But I wouldn't say we're the fastest, and as a result, we haven't grown the biggest either, because again, at a certain point, it comes down to how much money do you have to acquire new customers, and we always have a limit to that because we're looking at more of the near term and not the where we want to be in 5 years. So, I'll just end it by saying, as you scale, that equation starts to change. You become a little more bullish and a little more cavalier maybe, and you think, well, we have a good thing going. We've really proven ourselves. We have great metrics. We have the confidence of investors. There's a lot of demand for, in this space. Let's raise a little bit extra, and then we'll do a little more, and we'll go be a little faster. And I think that's what we'll see happen probably in our Series B. A little early for me to say for sure, but I think that's mentally how we're already thinking about the future.
That's great. Yeah, I wonder, Gertrude, especially with you and Ronaldo, and I know less about Wes, so I want to hear your, but like you two are, I feel like your skill sets really complement each other, and on top of that, it's the team presents really well to investors based on your backgrounds and what you've brought to the table. Can you talk a little bit about the importance of team as you're going out to pitching?
Absolutely. I think it is lucky that we do have really complementary skill sets, and I'm sorry that he's not here, but we obviously, we were very happy to be invited, and I'm happy that there's, another great company on the panel. And so the crowd today won't see Ronaldo live, but he's, he is really charming. Obviously, he's very smart. He definitely has a very different background. So I mentioned his background. My background has been, over 2 decades of marketing, right? So in consumer brands. And so in that sense, it's a really good fit. Also probably doesn't hurt that we're 2 different genders. We're really in 2 different age brackets. That probably helps us see things in a broader sense, than if we were really mirror images of each other. So I like that as well. Obviously I've now known Ronaldo for almost 4 years because he came to pitch our, the fund I used to be part of in the summer of 16. So, it has been a while, and we get along, just as good today as we did at the very beginning. I've been on the phone with him half the day already. So yeah, I mean, look, I add that in as a little color because I think chemistry is important. And when you're starting to pitch and you're in front of people who probably you may not know, right? And so that might be the first impression and the first time you're getting to know those investors. It really helps if the team, is in sync with if you're in sync with your partner, if you guys are getting along well, if you show that you're complementing each other's skills, you're not stepping on each other's toes. It's very enjoyable for the audience to be then presented to, right? As opposed to if there's like any kind of tension, that's awkward and not comfortable. And then once you get into a deeper dialogue with an investor, that's when they really start to appreciate the team. And at that point, it's more than just the deck and all the different numbers that they've previewed and maybe that first, pitch where you're really selling. They really want to know, like, what's the secret sauce, right? Because what makes this business run are the people. So it's really important, obviously, that you have the right team in place. And by the way, it doesn't have to be huge. Like I think I mentioned we're, a relatively small business still, and we really managed well with just a couple of executives for a very long time, meaning we didn't have the benefit of a CMO, a COO, a CTO. Like we were those things. And then as we grew, we started to layer in first really consultants, because that's what you could afford. Like I would take somebody who really knows their game for less hours and somebody who's more green for more hours. So we kind of went that route. And those consultants eventually got absorbed into our business because they liked what we were doing. We liked what they were doing. It's also a good trial run. And then you grow your business, kind of laterally. But yeah, obviously when you're pitching, the more you can demonstrate that this is a well-oiled machine, highly functional, that those cues go a long way to securing funding.
Yeah, thank you for that. Wesley, any thoughts? I know that, for you specifically, that PhD is really like a star, right? Like it's a great signal of your expertise. Can you talk a little bit about that and maybe other elements in this question?
Yeah, of course. So certainly being in biotech, having a PhD in whatever you're trying to bring to market or trying to build is definitely going to be a good signal. But for myself, I mean, I'm a first-time founder, first-time entrepreneur. And really the whole Y Combinator philosophy, which is kind of how I like to frame how I view things, because really that's where I was, I guess, trained on this the most so far, is that, founders can learn to be the business side of things. Founders can learn to be the CEO. But generally that's, I think, been a lot easier in tech or like software. And, more recently, or I guess really not quite yet, VCs like to see a experienced biotech CEO at the helm of a biotech company. And so I think as far as that aspect of our team, I think, when we first launched out of YC was kind of another weakness of our pitch. And I only had one other full-time co-founder at that time. And then I actually ended up losing him just because of our runway concerns. And so we kind of needed to go super low burn for a little while. So we've certainly had, been up against some challenges there. But as far as the team, I definitely think that it is really important, that you have a well built out team. So we have finally now hired somebody. I can't talk about them yet because they're not official, or I guess they haven't started yet, but we did sign a contract. And so, in giving a recent update to some potential future investors, they told me that of the recent progress of our group, hiring this person is actually their most exciting, the thing that they're most excited about, just because it helps to fill a technical gap in the company. And so, I guess just from that perspective, I can already see that hiring this person is going to be a huge help for us as we go back out, not only because of their expertise is going to help us day to day in the lab, but just because of at a Series A level, folks want to see that you have a team kind of already built out, that you have everything that you need. So, yeah.
Yeah, it's very interesting. Can you both talk about, I've heard a lot of people describe trying to raise money from angels or VCs as dating, like, are you going into a marriage? Can you talk about that, like that process of how long it took you, how many conversations you had, like how many no's you got, in order to get, some round of funding?
Yeah, I can take that first. So, I mean, we haven't technically closed any true VC funding yet. We have gotten certainly a lot of no's, upwards of over 40 or so coming out of YC. And so, but as far as angels, we have seen a lot more success. And then Reg CF, is not really dating because people just kind of, you know, wire you money on equity crowdfunding to some extent. But certainly with angels, you know, they want to get to know you as a person, and so it is a little bit of back and forth. And then I can already see, you know, in thinking about a Series A, that starting these relationships even a year out. So we're over a year out of when I would really want to raise a Series A. But, you know, having these coffee meetings, and now it's virtual coffee meetings, having those meetings just, you know, every couple months to talk to the same partner, really get to know somebody so that they know you, can hopefully eventually, you know, turn into them giving you a term sheet before you really even know that you're fundraising. And that's certainly the advice that I've been given from some partners at Y Combinator. That's what they've seen as success in the biotech space, is just continuing to always have these conversations so that at some point when you've hit the milestones that the VC has talked to you about, you know, they just give you a term sheet rather than you actively go out to fundraise.
Yeah, I would say that's, if you have the luxury of planning that far in advance, which is great that you do because of the way you funded, it's like you've had this interesting cadence where you now have the benefit of this gap, right, where you can plan ahead. I totally get that and think it's great. In a lot of cases, it's not like that, right, where you need the money, you need it now, and you got to hustle, and it's got to go very fast, and it never does. It always takes like twice as long as you think it's going to take in the best case scenario. So one thing I would say, it is a lot like dating, but like if we're honest with ourselves, then it's really very similar to dating in the sense that you'll know pretty quickly if you're getting the cold shoulder. And if you are, you really should walk away. And because some people have the tendency to just think, well, I'm gonna make them fall in love with me. It rarely happens, right? Just like in, you know, real life, if there's chemistry, you feel it right away. And then those are the people you should really pursue. And why I say that, because you could really spend a lot of time that is better spent other places. So, you know, what'll happen is you think if there's a little momentum, and some people, again, like in dating, they are trying to be, maybe in an effort to be polite, they sort of, you know, show an interest. But if you really look at it closely, you know, it's more just being polite. But you're so excited that you just think, well, I'm just going to continue. But what you've done is you've wasted time that could be better spent. And you kind of know from the questions and their posturing, if it's a sincere interest. And all I would say is better to walk, you know, just keep moving, and because it is a numbers game. And so similar probably to dating, you know, some people will hit it, you know, like meet that person and, you know, if you fall in love right away, but mostly it doesn't work that way. Mostly it's like you've dated a lot of people, right, before you really fall in love. And so it's really a numbers game with VC. I'm thinking more VC than angel, that you just want to get to as many people as you can, because you'll be surprised who winds up falling in love with you. It's not always so obvious. And it's sometimes, I'll even give another little, like, you know, not that this is like a secret, but something people don't often talk about. A lot of times when you hit it right, it has a little less to do with you and maybe more to do with that investor at that moment really wanting to make an investment. Like they have a goal for themselves. It's where they're running out of time, or they may have said, you know, I want to make one pet investment in the next 12 months, and they're coming up against the clock. So you'd be surprised that sometimes you just might hit it right. And so that's another reason to just like cast as wide of a net as possible, because you just never know where the money's going to come from.
Yeah, no doubt. And one point to that is I feel like a lot of times, especially first-time entrepreneurs, when they go talk to an investor, in that first meeting, they ask for an investment. And, you know, my advice to you, and I'd love to hear everybody's opinion, is, you know, make sure that that's not the first and only time you interact with them, is when you pitch them and then ask them for money, unless they know that that's coming ahead of time. The wisdom that we give is ask for advice, get funding, ask for funding, get advice. Just thoughts on that?
I think when you're fundraising, though, there's nothing wrong with being direct, but I don't definitely agree with you. If I think about like our first like conversation, it's just, again, like in real life, like I would never just move in and like for the kill. I mean, that's like, it's disgusting, right? Like, and it looks like it's an act of desperation. So, you know, we definitely use that first meeting as an informational meeting and let the information marinate. And like, if you get a signal back that there's interest, then I think you can be very like clear as to what your intentions are. So, I think you shouldn't be shy about, asking for funding. I think you're right, though. It would be a little bit awkward if like you just met the person and asked for something, I think that's not the right protocol. But I also, I guess the difference, a little bit of a difference, Assad, I would make is like, I wouldn't pretend when you're in that first meeting that you're just trying to get advice either. Like, I think you can make it very clear that
Sure.
you're teaching them. You just don't have to be so specific about what you're trying to, like how much, I mean, they often will want to know how much you're raising, but you don't have to be like, I need this money by that date. It's
Sure.
sort of like, the opening of a conversation.
Sure. Yeah, you definitely put it a lot better than the way that I said, for sure. Yeah, no doubt. We're getting a ton of questions in,
Sure.
and so question: how do you even go about finding pet investors, and how do I find out what investors have funded pet companies recently?
I can give you a couple of resources. Some of these things, there's like free access, and then if you pay a little bit, you'll get a deeper level of access. But resources like PitchBook and Crunchbase, those are two really great places to look, because they will keep track of like every investment made. And if you're, there's always like some level of free access. And then I guess if you sign up for a service, like you may be able to, search, with certain keywords, but that's just broadly, that's not just for the pet space. I think, the internet is just a wealth of information, right? Like if you just Google top pet investors, I'm sure you'll find an article about, somebody's written about like all the active investors in the pet space. Like it won't be hard to find, but if you want it to be more of like a database, PitchBook and Crunchbase would be the two places I would look.
Wesley,
Yeah, I mean,
go ahead.
I was just going to say, I totally echo that. I mean, for biotech, you can look at, for us, I guess I look at the different companies kind of in our same technology space on the human side of things, and reach out to those investors. Some of them say, they're not interested in animal health, but of course, everything that we do, we think of human health as well. And so I think that the odds that, one of our big investors in the future is, really heavily invested in the same space on the human realm of things is probably pretty high. And so for us, I guess it makes it a little bit easier because we can kind of look at the human side of the biotech space as well.
And one thing that I would add is that investors talk to each other as well. And so, as you are meeting investors, it's okay to ask them for any introductions to other investors that they may know, especially angels. They love to connect. And just an example today, this week, one of the investors in our companion fund mentioned that she had a conversation with you, Wes, recently. And so it was just a nice kind of circle, because we've also been talking to Wes. And so it was great to kind of, share our feedback with each other about what we thought about the entrepreneur and the business and that kind of stuff. So investors talk.
I was going to say, just before we get off the topic, Wesley made a really great point about definitely don't limit yourself to pet investors, by the way, because like most of the investment in pet is probably coming from human food, or just, if it's pet food, or, like any sort of biotech, if it's, it would be unusual, I would think, to find an investor that only invests in pet. Like most will have a diversified portfolio. I mean, our one of the investors in our A round is General Mills. And so, we're in their, we got an investment from their corporate venture arm called 301 Inc. And they've made 12 investments to date. 11 of them have been human food and beverage. We're the first pet. So, that would be, have been amiss if we didn't reach out to them. But my thought was because they hadn't invested in pet food yet, but we knew they were active in wanting to get out, we knew they were sort of looking at pet because they had bought a big pet food company in the past. We just like, oh, this could be interesting. And actually, because we weren't really even competing that moment against other, potential pet investments, it actually worked out really well. So definitely be open-minded to the type of investor.
And it's a super small world too. I mean, just like, Assad just said, he was talking to someone who I talked to last week, and they both mentioned us. And so definitely don't burn any bridges. Don't be mean to investors. I mean, they all know each other, and especially in the pet care space, it's amazing how small the world is. So
and ask for feedback as well.
Yeah.
A few people on here, or maybe the same person, is just saying that a lot of times that person gets people are interested, but they don't really know the pet market, or that they're more tech investors. Any thoughts on that? I don't know if it's a question more than a comment.
You just gotta, that's the fundraise grind,
Yeah.
That's what you signed up for.
Yeah.
I would say there's two things. One, you do want to spend a certain amount of time educating the investor. If you've gotten a meeting with them, there's some level of interest, right? So you want to give them the benefit of spending a little time up front, which may not help you directly, maybe educating them about other potential investments. But, your deck probably wants to be structured so that there's some upfront, education about the space in general before you get to Peplete or to your particular company. And then the other thing, though, I would say, and we ran into this for sure when we were raising our A, that if there's a complete misalignment, because we had a couple of investors say, this doesn't make sense to me, because I know when I looked at this, in the human food space, or this in the human, DTC space, it worked this way. And we'd be like, yeah, but the thing is with dogs, it's like this. And it just made no sense. Better to walk away. It's okay if you can agree to disagree. If you think it makes no sense and it isn't worth, whatever, you can think that way. I'm not going to be mad at you, but you don't have to spend all your energy trying to convince them. Because we did that at the beginning, and we're like, okay, this is really a waste of time. Like, why am I getting into an argument with this person? What am I going to win at the end of the day? He's or she's probably not going to invest. So what was that all for? Just you'll get it quickly. Like, if they're not getting it, then it's okay. Just move on.
That's 100% right. And one thing that Isabel and I have on offer, we've shared this with a bunch of people on here. If you ever come across an investor that is interested but doesn't know the pet industry very well and wants to learn more, send them our way, and we will educate. Well, I'll spend a half an hour with them talking about the pet care industry and why, the trends and all that kind of stuff. Happy to do that and be a resource to you all as you're talking to investors. So yeah, please let us know. Happy to open it up for more questions. One question that you both went through accelerator programs, and I know, Gertrude, you talked a little bit about your experience, but just why did you decide to go into an accelerator program, and what is it that the benefits that you got out of it?
You want to go first?
Yeah, sure. So for us, why? We knew we had a startup idea. We knew we had a technology that we feel can really transform the industry. And so we were looking at, the best accelerators in the world to help us get off the ground for that. So one, of course, is IndieBio in the biotech space. So we talked to them, and then we, applied and successfully got into Y Combinator. And so for us, really, I think the biggest thing that YC brought to our company is immediate legitimacy, as far as a company that is building something with a strong team and strong technology that can be worth $1 billion. Those are the three things that YC looks at before they invest in a company. Also, I think just the network, knowing that now I have access to the expertise at Y Combinator. Not only that, but there are over 2,000 companies funded by YC, and everyone wants to help everyone succeed. So that's really useful. And then also, being an accelerator program does get you introduced to investors. And again, you have that legitimacy as soon as you reach out to them. So those are really just the quick hits on why I think accelerators are great to get into.
Yeah. For us, it was also really important to actually add a little more discipline to our organization. And in an accelerator, you're held accountable in a way that actually feels good, because when you're just you and your co-founder and maybe one or two other people, you're kind of making up your own rules as you go. And, it's great to be autonomous, but sometimes the structure of, what a third party kind of imposes on you is good. It actually motivates you, focuses you. Then I would agree 100% with the network effect. We were just lucky because the players, or the part of not the players, the groups that run LEAP are just, we often said about Mars, the product development team that they assigned to Peplete, when we said that was one of the things we were trying to achieve, we never have access to that talent, frankly, because that talent resides inside of global companies like Mars, right? They're not for hire. They aren't the consultants that you can pay by the hour to get advice. So you just really have no access. So that kind of like access was really key for us. And then I would also just echo what Wes said about there's a network effect of just, you can get to other people maybe through like your mentors and stuff, but there's also just the peers, right? So the people, we still are very tight with the people from our cohort, and I've gotten to meet a couple of other people along the way from other cohorts that have reached out to me, and that's just a great feeling to know you have like a peer group that you can really call on because you spent real time together and you bonded. And so when you have a real problem, you can call them and say, I'm really stuck. What do you think? And you're not like afraid of like, what are they going to think? Or, are they going to talk bad about you? That's not going to happen because you were really like bonded over that experience. So that's been a great thing as well.
And for the record, Isabel, maybe you can provide some links into the chat, but there's definitely the Y Combinators and the Techstars of the world that are global, that have accelerator programs in every city. There are also accelerator programs or incubator programs usually associated with many different schools, colleges and universities. Every city has a different, shape and then of course there are pet care specific ones. Leap is one example. Purina, Nestle Purina has a pet care innovation prize that they run every year. There's a group out of Pennsylvania that does some stuff with companies that are product companies, CPG companies in the pet care space. And there's an Israeli group that's doing some stuff. So there's definitely a bunch of them out there, and happy for, if you guys are looking for resources, come to our website or ask Isabella or I. We're happy to point you in any direction. And of course, we'd love for you to apply to LEAP as well. One other question is just like best practices when you're trying to fundraise. Like, what is it? What are the best things? Like how to, in terms of communicating with an investor, in that meeting with an investor, or over Skype or whatever, like what are the best things that have worked for you?
Do you want to start?
Yeah, sure. So, they're taking their time to talk to you. And as you said in the presentation there at the beginning, Assad, they talk to hundreds of companies, a year. And so take their time with respect and be prepared for the meeting, research them beforehand and have good questions for them because they're going to have good questions for you probably to start. And then also just follow up quickly. So, they'll ask for probably a pitch deck after you talk or maybe before, or they'll ask for follow-up information. And, I don't keep them waiting a day or two to send that. I send that, almost immediately after our call, certainly by the evening. And then, things do get lost in an inbox. And so I just set a reminder, reach back out in a week. If you don't hear from that one, well, then they're probably doing that cold shoulder type thing. And so, yeah, just best practice, that I like to think about is always be respectful of their time. And then you're always, innovating and iterating on your pitch as well. And so take feedback that you get from an investor and change your pitch or change the way you talk about something, maybe A/B test your pitch with different investors to see what works.
Yeah, I agree with all those points. I would also say this, which I think is almost like, not really maybe acknowledged enough, is that you really need to know your numbers. Like if you're the idea person, if you've had this vision, if you're great at like, putting the product together, if you're good at marketing, it's all good and fine, but the investor, remember, wants to make money. And so you really have to know your numbers cold, and a lot of people don't. And it's because they've either worked with a third party, firm to like help them prepare the numbers, or maybe they have a finance, head that, has helped like get the data together, but isn't maybe in the meeting. There's no excuse. Like if you're in the pitch, whatever your title is, you need to know the numbers, and you need to be able to, I'm not saying memorize every single, budget item. I just mean like when they ask for those key metrics, you need to be able to state what they are, defend how you, got to that, how that, kind of why that equation makes sense, and really, be able to, talk about the future, like what the forecast looks like, and explain how you're going to get there and defend that. And that's a very important part of the conversation. And if that's missing, you shouldn't be surprised if they maybe love the idea and the business, but couldn't get their head around the investment.
Great advice. Yeah, for sure. One of the best things that I heard a startup do is after every meeting with an investor or an advisor, they would write out in a Google Doc the questions that came up and then write out their answers just for themselves to keep track of, because you'll be surprised how often the same questions come up, all the time. It's great to have a prepared answer, and test those out for what works and what doesn't work. Question how did you guys establish your first valuation?
You can take that one.
Like the very, very first valuation?
Or maybe any valuation. How do you establish it? Yeah.
Because the first one is hard. So if you're pre-revenue, that's really tricky. And there's no real, magic behind that. I would say there's no formula behind it. It's very subjective. It is more like magic. It's once you have a business and you have some history, then, there's certain multiples that make sense, and sometimes it's a multiple of revenue. Sometimes it's a multiple of ARR, your annual run rate. Sometimes it is a multiple of EBITDA if you're in a more mature, stage. I would say for startups, like emerging growth companies that are at that seed stage or Series A, so let's call it seed to A, which is, I think, probably this relevant to this audience. It's probably going to be a multiple of ARR. And why do you choose ARR and not revenue? Well, your ARR, annual revenue run rate, is basically looking at if you were to just continue to earn, like if the company were to, if the company's revenue was to say even just stay the same, right? This is what the revenue would be for the next 12 months. You want to look forward, not backward at like the last 12 months. And then a multiple of anywhere between, 2 to 4x is usually like what I think investors expect in the pet. If there's something really unique, if it is like technology based, if it's software, things that, tech, maybe biotech, things that can scale rapidly, you're probably going to even push above 4. If it's more of a retail product that's a little bit slower to move because you have to get it onto the shelf and all of that, and distributors and all that, you're probably lower, 2, maybe a little low, but you might be in that area. So that's probably the way I would think about it.
Great.
For us, we launched out of Y Combinator, and so we took the valuation that most companies do at YC, which was 12 million post money for us, which we realized was quite too high for us. And so when it came to the WeFunder campaign, we wanted something, we were trying to raise $1 million, and we wanted to think about how much we felt was fair to dilute ourselves, I guess, in a seed round, thinking about how much capital we would need as a biotech company to really, get to market and be fruitful as a company. And so, we started at a $4 million valuation there on WeFunder for like the first 300K in, just kind of as like an early bird discount. And then we jumped that up to a $6 million valuation after we got that 300K. So really it kind of fluctuated a little bit, but we, felt that our technology team and then being funded by YC, kind of gave us a valuation of around the, 4 to 5, 6 million range.
Right. We're coming up towards the end of the hour, and we'll stop very shortly. Hope had a question about the difference between, I think, accelerators that are for-profit versus nonprofit, or serving for-profit companies versus nonprofit. I'm still unclear about the question, but at least someone who I've been running accelerator programs for the last 10 years or so, and we've had both nonprofit and for-profit companies. I think the best thing you can do is just find out the success of the companies that have come through that accelerator program in the past, regardless of their for-profit or nonprofit. And the big thing, as people that they've talked about, is the access to the network and whether you can get the advisors to get your startup or nonprofit to the next level. So that would be, just making sure you do research.
I think that's I hadn't thought about that, but if you could definitely look at the graduates and see if they've been able to scale. I know with like our cohort, they've been very successful, and they were all really early. So that would definitely be a great indicator of how strong the accelerator is.
So we're wrapping up now. Any parting advice for if a startup that's about to go pitch to investors or anything like that?
I mean, there was something you had in one of your slides that I thought was really interesting, Asad, which was, you know, you actually need something to, a proof of concept that to pitch, you know, against. Like, you can't just have the idea and expect people to take that leap of faith. I really thought that was very prescient because, you know, even when we invested in Peplete back when I was on the fund side, you know, Ronaldo, he just very much, you know, the old fashioned way, he started making food in a commercial kitchen, which you would rent by the shift, you know, 4-hour shift. Actually, the first person he co-opted into helping him manage the kitchen is now, 4 years later, our product specialist in the company.
That's awesome.
Stuck with him for the whole ride. But, you know, he was cooking it in a wok, and then he was putting the food in plastic baggies, you know, Ziploc bags, and then he had a little cardboard box he designed, and then he'd throw it into you know, a messenger bag with some, you know, just some like ice packs, gel packs, and he'd get on a bike and he'd you know, literally go door to door. And when he got a little bigger, he hired 2 bike messengers, friends that he knew that were just doing that as a job. And, you know, just through his network, he got in touch with. So, you know, it was really like the old fashioned way of like proving like that people really want this. And he had like an 88% retention. Like anybody, it seemed like almost everybody who got the food wanted more of it. And that was what, as investors, we needed to see. And it would have been very different if he had just come to us with a business plan. And by the way, he had been doing that over like 7 or 8 months. So it wasn't 7 or 8 weeks. Like, but I'm sure it was one of the hardest, you know, probably physically one of the most demanding things that he did, because he was actually doing all of the work himself. But, you know, you almost have to be willing to invest that type of energy, and before you start expecting other people to invest dollars in you, and try not to leapfrog over that and just start raising, because you'll probably be disappointed. I'm not saying there's not some ideas that can get invested on a business plan, but a lot of things, especially when it comes to like anything physical, you really have to, unfortunately, spend a lot of like, you know, hard-earned, you know, money and your precious time to prove the concept out.
100%. Yeah, Wesley, you want to add anything?
Yeah, you know, I guess just closing, we're all, you know, in here because we are doing something for pets. I mean, how much more fun can it be to have a startup that has to do with our dogs or cats or other pets, right? So just be, you know, be hungry every day to help our dogs and cats and pets live a better life. And then you know, I'm sorry, I'm getting a PA announcement here at Mayo Clinic, but I'm a big fan of Reg CF and WeFunder, so I didn't get to talk a whole lot about that today, but you know, you guys could check them out. I think people love their dogs, and so if you have a direct to consumer company and someone likes your product, I think raising Reg CF money could go pretty well for you, because people would want to own something that they use already. And so I'd be happy to talk with people offline about Reg CF,
Yeah,
or
certainly.
you know, on another call or anything like that as well.
Yeah, this hour went a lot quicker than I thought it was going to.
Always does.
So yeah, if people have more questions about anything, please let us know, and we can connect you to the right people or that can get you your answers. And then also join us on our Slack channel for conversations as well. Wesley, Gertrude, thank you so much for your time today. Really appreciate it. And this was really helpful and informative. And wishing everybody a great couple weeks. Hopefully everybody's okay with COVID and safe with what's going on. So thank you all, and we'll talk soon.
Okay, bye now.
Thanks for the invite.
Thank you.
Bye-bye.